Harrison, I'll kind of give you the floor here. What's going on with Roth accounts?
What's going on with them?
Well, are they good?
It depends. It depends, right? So I'm mainly going to be talking about Roth accounts here, but I don't have a preference one way or another, so I'm not promoting them as better than pre-tax accounts or other types of accounts or anything. These are just some components of it. And ultimately, when you're making the decision of should I contribute to a pre-tax account or should I contribute to a Roth account or should I convert from pre-tax to Roth, the main thing that you have to look at before getting into the details of these other nuances is what's your tax rate now and what's your tax rate going to be in the future. That is 80% of the issue right there. If your tax rate is high now, pre-tax is probably better. Get the tax deduction when your tax rate's high. If you think that your tax rate later on could be high because you're going to have RMDs or you're going to have pension income or you're going to have inheritances or whatever accelerated income you might have in the future, well, maybe a Roth account now would be better so that you can access that money tax-free when otherwise your tax rate is higher. So that's the main thing.
I would just say, the funny thing is you have to also take an objective view on this. Is your tax rate high? I think most people, you ask them, are they paying too much in taxes? I would say most people would say,
I'm
yes.
not paying enough. I wish I could pay more taxes. No, you're right. You're right. Everyone thinks that they're paying more in taxes. I talked to somebody earlier this week and they're like, I got crushed on taxes last year. I owed money. Oh, how much? $3,000. Okay. That's a lot of money. $3,000. Yeah. I'm not saying not, but I mean, $3,000 is more than $500, but it's also less than $60,000, for example. So everything is relative. Everyone thinks they're paying more taxes unnecessary, and that's why you have to look at the rate that you're paying.
Not the refund or what you owe. That's the worst thing you can do.
The refund or the payment that you have is almost irrelevant because the tax that you pay is based on your taxable income, which is the accumulation of all the income that you have. That gets applied to the tax brackets. That determines your tax liability. You getting a refund just means you paid more throughout the year than maybe you should have. You making a payment at the end of the year means you didn't have enough withheld or you didn't, make, enough payments or estimated payments throughout the year. That's all that means. So when you're looking at pre-tax versus Roth, again, what tax bracket are you in on the federal and state side versus what is that going to be in the future? That's really what it comes down to. And you can say, well, we don't know what tax rates are going to look like. That's true, but you also should have an idea of what your income is going to look like based on, your Social Security, your pension income, the amount of money you have in pre-tax accounts. Money that you have in an IRA is income. It's going to come out. It's going to be taxable. It's just a matter of time. So based on the amount of money that you have and what that'll grow to, you can get an estimate for, okay, well, this is approximately the range my future income should be. Based on that, this is the tax bracket I should be in, and that's, how you determine that. But anyway, getting into the point that I wanted to talk about here, when you look specifically at the Roth accounts, there's three things that are kind of secondary little benefits that come from that. First of all, Roth accounts don't have required minimum distributions. So right now, the age to start those RMDs, as they're called, is age 75 for anybody born year 1960 or later. So you have to take those starting at 75, and every year you get older, you have to withdraw a little bit more from the pre-tax accounts. Roth accounts do not have to do that. And the taxation versus tax-free component of it is not really what matters in this case. What I'm talking about is the fact that you don't have to take a required distribution means that money can stay in that tax-free account and continue to grow. If you have a pre-tax account, even if you have to, pay taxes on it, whatever the tax rate is, the fact of the matter is once a required distribution happens, that money can never go into a retirement account again. It cannot go into a tax-advantaged retirement account. It can go into a taxable account, but from that point on, all the earnings will be taxable every single year. So any interest, dividends, capital gains that you have are all taxable. So the fact that Roth money allows more money to stay in a tax-advantaged vehicle for a longer period of time as opposed to forcing you to take it out and do something else with it, that's a benefit.
I would say, too, you think about this long-term, we see this sometimes, they retire and I don't want any money. I want to leave it to my kids. Well, that's really nice. Is that right or wrong? I don't really care. It's your money. Do what you want. Right. But you think about now the benefit, right? You're not pulling any money from that. Then when the kids inherit that money, as opposed to a pre-tax IRA or a pre-tax 401k, you have to be very careful. Otherwise, you have a ticking tax time bomb for 10 years where you'd have this huge tax liability, where if you inherit a Roth, you have 10 years essentially where you wouldn't have to pull that out, and all that is tax-free growth. It is definitely a hidden benefit that is
And that's
huge.
that point that you bring up is the second point that I wanted to
Stole
talk
your
about.
thunder.
It's like you reading my notes here. No. Because again, you don't have to take the RMDs when you're alive. But the next point, as you say, Chase, is from an inheritance perspective, a Roth account is better. Both pre-tax and Roth accounts are subject to a 10-year rule, which means if they are inherited by somebody who's not your spouse, like your kids, for example, they have to deplete that account over 10 years. Pre-tax accounts are still taxable, so generally what the best thing to do is just take equal amounts over those 10 years because it's income, and that way you don't get pushed into a higher tax bracket. But the reality is, if you inherit $1 million pre-tax IRA, you might have to withdraw $100,000 or $125,000 a year every year for 10 years on top of the income that you have. That's probably enough to push you into a higher tax bracket. With the Roth account, you still have 10 years, but it's all tax-free. And you can wait until year 10, so get 10 years of extra tax-free growth. And then as that beneficiary, you just withdraw it all in year 10. So if you inherit $1 million and it grows to $2 million, that extra $1 million of appreciation is also still tax-free to the beneficiary. So from an inheritance perspective, Roth is better than pre-tax. And I was
just going to say that I would not be surprised if that changes.
I think it
over
will.
time, because
I think
it's
it will.
like just that benefit is so huge that I don't think it's going to be now a negative to inherit Roths or a negative to have a Roth in retirement.
No.
But it's just going to be not as big of a benefit.
The playing field between that and pre-tax accounts might get leveled because right now Roth accounts in that context has the advantage. So no RMDs and better from an inheritance perspective. I think both of those potentially will change. I think there could be required distributions that happen. The reason why required RMDs happen anyway is because the IRS says, well, we've given you this benefit of deferring your income. Now we want tax revenue from that income, so they make you start doing it. But, the other benefit is from the Roth side is, well, you're just, keeping that money grow tax-free as opposed to withdrawing it out and then investing in something else that's ultimately going to be taxable. And then the last thing that isn't as important for most people, but it's still a benefit, is the estate tax impact of it. And so right now, and the reason why I say it's not as important is right now the estate tax limit for a married couple is like $28 million. And now with this tax bill that got passed a couple weeks ago, that high limit got made permanent until it gets changed again by whoever. But there's no sunsetting of that, so that estate tax limit is not going to be cut in half starting in 2026. But when we look at pre-tax versus Roth accounts from an estate tax perspective, both the full value of an IRA and the full value of a Roth account are included in someone's taxable estate. So if you have $1 million in an IRA and $1 million in a Roth, you're going to pay the same tax rate from the estate side on both of those accounts. In addition to, you're also going to pay, your income taxes on the IRA as well. So when you look at the fact that pre-tax money is taxable, $1 million in an IRA is equivalent, depending on your tax rate, maybe to like $700,000 in a Roth. So, but if you happen to die and you're subject to estate taxes, even though from an income tax perspective, those accounts are essentially equivalent, you're going to pay the 40% estate tax on the full $1 million IRA where you'd only pay it on the $700,000 in the Roth.
So kind of the way I'm thinking about it is, let's say just for simplicity, you're worth $15 million and you have $1 million in a IRA, and the rest is in real estate that you don't want to liquidate when you inherit it. You're going to have to pull that money from the IRA, but the problem is to pay that 40% estate tax, it's going to have to come out of the IRA. Then on top of the estate tax, now you get taxed on the distribution amount as well,
yes.
where you wouldn't have that on the Roth.
There is a little bit of a deduction the estate gets when IRA money has to be depleted from it, but it's not enough to fully offset the cost of having the money. So, 40% of $1 million is more than 40% of $700,000. So in that scenario, it'd be better to, try to get money into the Roth. You're still going to pay the income tax anyway, whether it's now or later. And if the rate's the same, you're better off getting into the Roth so that $300,000 difference isn't subject to the estate taxes as well. So those are the three benefits. But again, I'm not like pro Roth or anti pre-tax or anything like that. I have both accounts. So do you, Chase. So does Brent. Doesn't have any Roth accounts, I don't think. It depends on the situation.
Yeah.
So, but these are just some extra secondary benefits that sometimes are helpful, but I do see potential legislative changes in,
I think there should be from a taxation perspective.
Probably, yeah. I mean, I don't think it's it's been talked legislatively that it has a little bit, but I don't think there's been anything really done because it's not very common to see extremely large Roth accounts
Yet.
Right, exactly, because Roth accounts are relatively newer. Like we've seen an IRA with $8 million in it, or $10 million in it, which is a lot because you're limited on how much you can contribute every single year. So not only do you need to max that thing out for a long time, but you also need the money in there to grow a lot to be able to, grow to $8 or $10 million in an IRA. I've never seen $10 million in a Roth. I've seen $1 million a few times, but it's just not as prevalent, and I think that's why legislatively they haven't done much with it yet.
Yeah, I don't know the full numbers on how much is in Roth IRAs versus pre-tax. I'd assume, again, there's still more in pre-tax and Roth.
There's way more.
Why it's not as discussed, but I think that'll continue to kind of narrow, and as that does narrow, I would not be surprised to see changes. But
pension money's pre-tax, so when people have lump sum pensions, that gets rolled into a pre-tax account. Now, matches are pre-tax. So there's just more contributions going into the pre-tax side of things. So, and that's probably always going to be the case. Pre-tax is probably always going to be more popular, or at least a larger number of assets. But the Roth accounts are growing. So we'll see how it goes. But again, a couple little benefits to keep in mind, Don. If you're very close, if you're like in the same tax bracket and you're always going to be in that tax bracket, I would probably gravitate toward a Roth better than a pre-tax, or try to convert into a Roth.
Yeah. Well, as always, Harrison, great information there. And it is so dependent on, again, that person's situation and their financial plan. So if you are interested in setting a time with Harrison and learn more about financial planning and what he does for his clients, including why he might like Roth or pre-tax for your situation, give him a call. Phone number here, 858-224-0004. Again, 858-224-0004. Or go to the website, smartinvesting2000.com. Again, that's smartinvesting2000.com.